Welcome to the Broken Pie Chart Podcast, episode 308. I'm your host, Derek Moore. With me today, my guest co-host, Mike Puck from Zega Investments. Mike, you've been on the program before. I know it's been a while. What's going on today, Mike?
I'm good, Derek. Thanks again for having me. It's been an interesting start to the year here, market-wise. A lot going on with the inauguration coming up next week. So business has been very busy for us at the start of the year, and we'll see how we kick things off.
All right. So I wanted to start off with the first thing, and I'm seeing a lot of stuff written about, hey, the Mag 7 is such a high percent of the S&P, and I have a problem with this. And the reason why I have a problem with people focusing on this, sure, there is concentration, but here's the thing. When you look at, and just to put a number on this, right now, I don't know when this is as of, Mag 7, largest S&P companies, 34% is the weighting within the index. Then if you're looking at a chart in this, 2015, it was like 15%. 1980, it was like, 20%. And then you see them put out charts that say, well, when it gets this high, there's going to be a recession. Mike, I went back and Yahoo Finance had a chart. And what they did was let's see here. What do we got? 28 years later. So I know you already looked at this, so I can't be like, yes. But January 17th, 1997, I'm just going to go through some of these.
Yep.
The number one company in market weight. So that's like Apple right now is the number one weight. Or actually, I should check that. I didn't check today. But, it's like $3 trillion. $170 billion was the number one market weighted company in the S&P 500. That's GE. Number two, Coca-Cola. Number three, Intel. Number four, Exxon. Number five, Microsoft. Microsoft is still around. So good for them.
Right.
I mean, the other ones are still around too. Merck, Philip Morris, IBM, Procter & Gamble, Johnson & Johnson. And you look now, like Intel's market cap right now is 206th biggest. GE is 68th. Microsoft was 5 back then. Now they're 3. So they've actually moved up. The point of me bringing this out is, the S&P, it's part of the reason why we like being in the S&P, hedging around it. We do that. But this index is a living, breathing thing. And the idea that, we're looking at this and saying, well, there's too much if there's too much concentration, eventually maybe these companies come down, maybe they don't. But this also gets to the idea of the index was much different 28 years ago, 30 years ago. And right now, everyone's focused on Shiller PE being high and forward PEs and things like that. But there's no way we can look at this index the same way as we do today because those were different companies back then, Mike.
Yeah. I mean, it's totally different. I mean, you're looking at this list right now. I think you called out 2 tech companies, right? Microsoft and IBM for the top 10 back in, 1997. So if you look at today, right, the majority of the companies are tech right now. So I think what people don't think about too often is just how active the S&P 500 is. Like it's an active index. Like you said, it's living, breathing, right? It's very active. Companies are moving around. They're dropping companies out, right? As other companies get bigger to pop in the S&P 500 when they do that rebalance every year. And, it has really pushed and drove the market, the Mag 7. I'm looking at a chart here of 2024 performance, and Mag 7 was up 48%. And then S&P 500 X Mag 7 was up 10% last year. So that just shows you the discrepancy between the two. And what the market was about 25% last year, right, Derek, the S&P 500? Yeah. So Mag 7 really, you market weighted, carried the index there. So coming off 2 hot years of the Mag 7, that doesn't mean that those are going to be, the top companies in the next 20 years, or this is a 28-year look back. 20 years, 30 years from now, we could be looking at something totally different.
Well, I think that's right. I mean, I always tell the story about in March of 2000, the number one weighted company in the NDX 100 index, the NASDAQ 100 index, was Sirius satellite radio. Like blows
Right.
people's minds when I tell them that. And, you know that, and the audience has heard me say that before. Like, that's a trivia question. Like, good luck getting that. So, yeah, I mean, it is a living, breathing thing. I was just looking, too, at some of the companies that came into the S&P 500 in 2024 that were not previously, and it includes Supermicro Computer, which I don't know, did they get kicked out? Maybe not yet, but they had some accounting things.
Yeah, they did. They got in trouble for something.
Interestingly enough, and it's also the percent change since they joined the S&P 500. They're down 70% since they joined. Decker's Brands was a new one, up 34% since they joined. KKR, that's a financial, up 38%. CrowdStrike, GoDaddy, Palantir, Dell Technologies, Erie Insurance, Apollo, and Workday, and Texas Pacific Land Trust. Looks like an energy one. So think about this, like CrowdStrike wasn't in the index. Palantir wasn't in the index. So there are new companies. NVIDIA was not near the top 10, like 5 years ago?
Right.
So this is why we buy the S&P. And inevitably, like, you're getting companies that are growing and grow into the S&P. And because it's weighted, it's kind of a momentum index at the same time. Like, your momentum being, momentum traders might buy more of a stock as it's going up. They might sell things, if you're a trend follower, you're selling things on the way down. It's just a living, breathing thing. And new entrants, people coming out, it changes the makeup, and all the earnings are aggregated together. So I don't know. I would just find it fascinating to go back. And the reason, Mike, I'm bringing this up too, is people look at return to the mean and what that is, return to the average. And they start talking about net profit margins. And then you have things like the Shiller PE, which I can argue against. 1997, we just told you the makeup of the index. Like, of course, the margins aren't going to be high for Philip Morris as they are with NVIDIA today. It's just not the case, Mike.
Yeah. So talking about the index specifically, this is something I brought up last year on the podcast. It was probably about a year ago, was the value and growth market. Right. So if you look at the averages and when value is cheap or when growth is cheap, value a year ago, I would have told you, and I did tell you, I was on the podcast. I said, hey, look, value is cheap compared to growth. That typically means, value should be in favor. I think a lot of people called for value to have a good year, and growth led the way again. And this goes to why we're not trying to pick growth or value with Zega, right? We're buying the S&P. It's such a solid, strong index. I don't know what's going to do better next year, whether it's growth or value. According to the charts right now, value's still cheap compared to growth, and growth is expensive. But as we look at things and as the market progressed through the year, right, it was the same. We're basically in the same spot, value versus growth, as we were a year ago. And we'll see what happens. I don't know what's going to happen, but the market in general, the S&P in general, if you're not trying to take sides, right, just buying the index is actually very active, like you talked about, adding these new companies like CrowdStrike and GoDaddy, Apollo, Workday, right, and then dropping out some of the other companies, and then even the top 10 moving around, right. So I looked that up too, since you said the top 10 from 28 years ago. Right. And this will be no surprise, right? Top 10, Apple, Microsoft, Amazon, NVIDIA, Google, Tesla, Google again, actually, but Berkshire Hathaway, Meta. Geez, I mean, that's really all. That's all tech. Those are the top 9. United Healthcare and ExxonMobil make up.
Well, and Berkshire holds, I mean, I don't know how much Apple they own now, but at one point, I think a good percentage of Berkshire was Apple, which was tech. They've reduced that since, but.
Right.
But yeah.
Yeah. So it's just, that's really neat to just see how things completely flip. So I said this before, but two companies were tech 28 years ago, and now 9 out of 10 are tech.
Isn't it crazy? I mean, you think about Intel. Intel was Now, I was in the markets. My first full year in the markets was 1994. I can tell you, 97, 98, 99, 2000, like Intel was the stock. It was one of those. I know everyone goes back to Cisco and tries to compare it to NVIDIA, but it was Intel. Like Intel was, you had financial magazines dedicating whole issues to Intel. And I don't know. I mean, look, I'm not a fundamental analyst. I mean, I can do discounted cash flows. I can read balance sheets. I can do all that stuff. Other people semiconductor analysts can tell you about Intel and whether they can recover, whether they can turn things around. But yeah, and just because, like, think about it this way, Intel was the semiconductor number 3. And now it's like these things change. They definitely change. But
yeah, it's incredible. It's not even top 10. And I'm just looking at kind of year to date. I mean, we're only 17 days in. But Apple,
really, you're looking year to date? All right, let's go.
I'm looking year to date. This is really interesting. Apple so far this year is down 8%. So, just like Intel was the beloved stock, of the late 90s and like you said, the tech company that everybody was talking about. And I'm not saying, Apple's going to have a bad year or anything, but it's just interesting to see just the start to the year, Apple down 8%. Most of the other companies are up, 1 or 2%. Meta's actually up 4.6%. But
sure.
Interesting conversations with Mark Zuckerberg that have been online recently with some of the changes going on at Meta. But he also talked about Apple and their kind of closed architecture when it comes to the apps and how a lot of companies are getting frustrated with that. So it's, everybody, like you said, was the beloved company was Intel. Probably if I would have asked you back then, here, I'll ask you now, but if I would have asked you back then, do you think Intel's going to, drop out of the top 50 of the S&P 500? What would your answer have been?
I would say no. And I'll take it a step further. I would have thought Nokia would have been the global leader in cell phones sold. Like it was all Nokia back then. And this is what happens though. I mean, new entrants come in. Amazon wasn't on anybody's radar back then it would have been, hey, who's going to be the biggest bookseller in the world? You'd say, well, it was Barnes & Noble's.
Barnes & Noble, yeah.
Here's the problem with value though, Mike, is that number one is a lot of times value when you sort of test it and you look and it says, well, it actually performed, better. When you include periods where like March of 2000 or the tech crash, value performed better, but it never went up as much. And the problem for someone allocating a portfolio is if you are going to allocate to value or international or anything else, really what you're saying is, I'm going to sell some of the S&P 500 and I'm going to use that to buy something else. It's the same thing with a 60-40 portfolio. You're essentially saying, well, I almost have to sell something to buy the other thing. And value is just it's not performed. And I know the value aficionados and the ride or die value people say it's going to come back. It's going to come back. Look, I don't know. If you want to buy value, buy value. If you don't want to buy it, don't buy it. But the arguments are, hey, net profit margins are too high, that the CAPE ratio is too high, that it's got to revert to the mean. And I don't know that that's the case.
Yeah, the value bros out there are having a tough go for the past couple of years. I think there's only 1 or 2 quarters in the past 3 years where values really outperformed. And again, this goes to why we think about the index a lot at Zega and how to get participation in that index, whether it's a 75% participation or 120% participation, right? We're thinking about the index, not value, not growth. The other thing that we talked about, I think this was last year as well, was the small cap story and the international story, like you just mentioned. Those were supposed to be big winners last year.
Nope.
Yeah, and they weren't, right? And I remember I was coming on too. I had just got out of the ETF conference here in Miami. And one of the first things we talked about was, hey, international is supposed to be hot and small cap is supposed to be hot. And S&P outperformed again.
And part of that's the dollar story and our interest rates are going up. All right. So TSMC, Taiwan Semiconductor, symbol TSM, it reported earnings on Thursday. That's part of the catalyst that I think has driven the some of the strength here in the last 2 days. The market is up over 6,000 again. But listen to these numbers, Mike. Net revenue for TSM plus 38.8% year over year. Net income plus 57% year over year. Gross margins 59% plus 6% year over year. Operating margin plus 49% plus 7.4 year over year. And net profit margin 43.1% up 7.4 percentage points year over year. And I mean, look, this like value companies don't do that.
Right.
They don't do that. I don't know what TSMC is going to do. All right. I mean, look, if you own some of these indexes, it's sort of, it may be in some of the indexes, it's a foreign company, so it's not in others. But I mean, the growthier stuff, the tech stuff, they've kept their profit margins much further, much longer than anybody thinks. Mike, one of the things I'll tell you too is if you go back, we think about, the forward 1-year earnings or forward PE. If you look at Amazon, Meta, NVIDIA, any of these companies like 10 years ago, and you looked at their price 10 years ago and imagine like a forward realized earnings plus 10, they were probably trading at 1 times or less than 1 times forward 10-year earnings. Like they grew into their valuations.
Right.
So it's just hard because the value is like, hey, there's no way these valuations can continue. But when they do their discounted cash flow analysis, they assume that a company has high margins, high revenue, it has high earnings growth, and then it sets down to more of a equal to GDP, 3% annual growth, like a 3M or an old line company. And these companies sometimes stay in growth mode longer. So it's hard. I know the arguments, and they're probably right. They're going to be right, Mike, at some point. It's hard.
Yeah. So I just sent you over a chart to that I'm looking at here for earnings growth since you brought that up. Look at Q1 of 2024. I mean, this is the kind of going to the tech and the growth in the Mag 7.
Q1 last year, you mean?
Q1 of last year. Yep. So Q1 2024, 50% of the earnings growth came from Mag 7. Or the Mag 7's earnings growth was 50%. The S&P 500 ex Mag 7 was -2. So that's a tough quarter for value investors.
Well, look at the year. I mean, the year on this chart is plus 34% pro forma EPS year over year. So that's 2024 in whole, if I'm reading this right, and only 3% growth from everything else. This is why you buy the index, though. Like the index, right. The earnings all get put into a pot. It all goes into the S&P 500 pot. So whether you have one company driving all the EPS or you have 500 companies, like your earnings per share on the S&P is what it is.
Right. Yeah. Yeah. We're kind of beating this to death here, but the bottom line is, trying to pick stocks, trying to pick growth versus value. It's just all very, very difficult. Looking at the market as a whole, buying the S&P, showing you how active it is, right? Look how active this is with all these companies popping in and out of it. So it's a very active index. And it's just hard to pick the winners. But if you own the index, you're most likely going to do pretty well.
All right. I want to get to something else that people have been talking about. And that's the idea of, hey, we just had 2 back-to-back plus 20% years. And the market can't go up again. Ryan Dietrich had put something, I think this is Ryan Dietrich, had put something out. And the title of it was, I guess I can send this to you, Mike.
Sure.
We're kind of making the sausage as we're live here, but I'll send it to you. Back-to-back years, up 20%. So 2023, 2024, up 26.1, up 26.7, 98, 99, 97, 98, 96, 97, 95, 96. That was kind of a good period. 82, 83, 75, 76, 54, 55, 50, 51. And you look in all but 98 to 99 and 75 to 76, the year after back-to-back 20% gains you've had these double-digit gains again. and the average is 12.3, the median is 12.8. Mike, I mean, this is really skewed, because 95, 96, 97, 98 were unbelievable years in the market. But the point is, like, just because it goes up 2 years in a row doesn't mean it's going to keep going up again. It's not going to keep going up again. Like, who knows?
Yeah. So this is really interesting to look at. And I kind of can't believe it, to be honest with you. It's just seeing that the market, the increase in the market after back-to-back 20+% years, right? So let's see, 1, 2, 3, 4 times you still had double-digit returns after back-to-back 20+% years. So the other thing to think about is the election. Year was last year, and so where are we in that cycle? Last year, the fourth year of election cycles, and when a new president's possibly coming in, 70% of the time the market is up, and we ended up positive last year. So what do we look at now, right? Post-election cycle, what happens? 47.6% of the time, the market's up. So it's about 50-50 that the market's up. The average the market is up in a post-election year is 5.6%. Right. So I think you've seen that slide before, Derek. We talk about that one a lot. So, so 50-50, I think part of the reason for that is, people promise a lot during the campaigns and during the election year, and then they win, and it's kind of harder to get things done than they said on the election campaign. So, 50-50 shot, the market goes up. But seeing that the market here, after double-digit return years, it's possible to have another double-digit return. I mean, that's great.
More than they go down. And it's just, in more years are positive than negative. And I will tell you that even in years that are positive, we do have drawdowns, which are totally normal. Like, I know people started to get a little bit worried, and it's like, hey, is it a drawdown? Is it a correction? Like, it's healthy. And to me, the market needs to. We've had good earnings so far. The banks have put out good earnings. I think even United Healthcare, I believe their numbers were good. There was something the street didn't like. Next week, there's not too many companies that are coming out. The following week is when, we have Microsoft, Meta, Tesla. But yeah, I mean, to me, like, it's healthy to have a little bit of a pullback so things can catch up. I mean, as far as the election year stuff, what people are looking for, I mean, the FTC has been very restrictive with mergers and, I would say with corporations as a whole. New administration coming in, that probably changes. Does that open up the merger window or the buyout window? Maybe. Does it mean less regulation for companies? That could be. You could get some aggregate gain in earnings there. It's potentially. So, I mean, I think that's what a lot of people are looking at, whether it's priced in or not, and whether we front ran that after the election result or going into the election. I don't know. But I think that's another thing is we don't know how much deregulation and how much the change is going to help companies, Mike.
Yeah, that's what everyone's talking about, right? As the advisors that I talk to around the country, everybody brings up the deregulation that Trump has talked about. In conversations with Jay, we talk about how that's going to take time, though, right? So yes, deregulation should be good for the economy. It should be good for the market. It should be good for small cap, mid cap, large cap companies, especially companies that are not profitable. I'm actually looking at a chart here that's showing the companies that are not profitable in the S&P mid cap and small cap market, and that's actually at an all-time low right now. So it's only going to help those smaller companies with the deregulation. But it's going to take time, right? It's going to take time. It's not going to happen overnight where, we wake up and the market just shoots up. I think we're going to be choppy here for a little while as things start to play out with the new administration. But how about the dollar, though?
I think
Derek?
that's lazy, though, Mike. All right, so I'm saying this with a smile on my face. I think it's like when you have again, I'll just be honest. Like, I don't think people learn much watching CNBC. I'm sorry, CNBC, but it's like one after another. Well, I kind of like this stock, or people come on and they're like, we could be a little rocky. It could, like, I think that's a lazy take. I think we'll know when we know. I mean, I would say in general, this administration is going to be less restrictive on things than the past administration. I think we can say that. But
I agree with you, but I think it's going to take time. It's going to take a little bit of time. It's not just going to happen overnight.
Everyone's saying the same thing. Like, everyone goes on CNBC and is just like, they're all just saying, and if you watch CNBC, they all say the same thing. Like right. A week ago, people started getting bearish. 2 weeks ago, people started getting bearish. Like, they were like, well, I don't know, we were in for a pullback. We could see. And, we look at the markets too, sometimes on a technical basis. We had a couple levels in mind on the S&P that were interesting. If it got down to, you'd say, does it hold support? But all right, here's a piece of news, Mike. Did you see housing starts? Yes, private housing starts. Let's see, 15.8% year over year. That was a big surprise. So that's when I bring this up, because that was another thing. Everyone's like, well, housing is going down. Housing, they're not building housing. And then housing starts go up 15.8% year over year. That's the highest since, I don't know, April, May of 2023. Like, that would be, we have higher rates, and it would be contrarian to say that housing is going to do okay despite higher rates. But there you go. There's housing starts. Just surprised people. I don't know if you saw that.
Yeah, I did see that, actually. So it's a 4.4% decrease from December 2023. So over the past year.
No, look at the chart I put in there. Private housing unit starts 15.8% year over year growth.
I'm looking here. I don't see. Oh, sorry. Okay, over on your email side. All right, looking for the housing. Yeah. So I am looking at that now. It seems to have slowed down a little bit, but
I don't think it's slowed down. Look at the bar. It's 15.8% year over year. That's December. Look at November. November was negative. October was negative. September was negative. Like, you had 3 months of negative year over year growth, and then December comes in at 15.8, which is, I mean,
where did that even come from? You're right here,
but that's kind of interesting.
Yeah, you're right here. I'm looking at this. I mean, it was huge growth in December.
Yeah.
And I know that you know this, but my wife and I are looking around to buy a property in possibly Colorado or Arizona, and I will tell you this: I can't even get a hold of the builders. When I talk to Lennar or some of the other builders, I mean, you got to call them 2 or 3 times. Their real estate agents are so busy. So, just from my personal experience, I know that they're building houses and people are moving out, especially out west. But the numbers are really interesting at the end of the year. They really seem to take off.
That's, I'd be curious, if you're, because we're not experts in the real estate market. It's interesting you've had that experience. I'd be curious to hear from our listeners. Derek.moore@zegainvestments.com. That's DEREK.MOORE. At Z as in zebra, E as in Eddie, G as in George, A as in Apple. Investments is up to you to spell correctly. But I'd be curious what people's experiences are buying and selling homes right now, because what you are saying is the real estate agents are too busy, or were they not busy enough and they all left, and now you just have the full-time agents that are left? I don't know.
Yeah, I would say the new builder real estate agent.
Builder. Okay. The new builders are too busy to take your call.
Toll Brothers, Lennar.
Yeah.
Those guys, have just been super busy.
So all right. I don't know what home builders have done lately, but we'll take a look at that. They're too busy. You want to buy a house, but they're too busy. Okay. That's a good problem to have, I guess.
It is.
Well, the builders were a contrarian thing last year. I mean, the builders did pretty well last year. And coming into the year, you would have said there's no way they can do it with higher rates. But I think the builders can give incentives on the rate side that aren't available if somebody's just selling their home. But All right.
Yeah, that's correct. They do buy down the rates. I think that's why new housing is moving maybe more than a house that somebody's lived in before. But they absolutely buy down the rates. Yeah. So even though mortgage rates are 6+%, a lot of times the new builders are offering 4, 3.5 the first year, 4.5 for 29 years after that. So that should kind of skew the housing numbers, right?
Oh yeah. If I can buy a new build at a lower rate versus buying an existing home at close to 7%, sure. I mean, I'm not going to pick a direction in the real estate market. I will tell you, if you go on YouTube, there are a million people telling you why the biggest crash ever in real estate history is coming. You can kind of go down that rabbit hole. And some of them, I don't know if they know what they're talking about, but they're quite convincing. But so far, I mean, the lack of supply in housing has helped. Like if there's demand, exceeds supply, then home prices can stay up. Like who's moving with a 3% mortgage right now, unless you have to?
Right.
Like you're not selling your home.
It was great to lock in rates at high twos.
You're going to do it. I mean,
yeah. It was a serious opportunity that I wonder if we will ever see that again in our lifetime.
But I'm saying you're theoretically going to sell your place with a low mortgage and buy a place with a higher mortgage. So you're the guy.
Yeah, we may be one of those people. Yeah. So that's the other thing. Geographic location that could get people to move. Florida and Texas, a lot of people move to those two states. I think a lot of people may be moving back to their home states. There was a squeeze though on housing for a long time. I've seen all the YouTube videos about crashes possibly happening. I honestly think at this point, the builders can't build fast enough. So I think that's going to keep things stable, but we'll see. Like you said, there's a million people with a million opinions on YouTube around the housing crisis.
All right, let me switch to the dollar. Last week, Spencer Wright and myself, we talked about a high dollar maybe becoming a problem. The idea is that the dollar, there's this zone, I call it the zone of insignificance, where the dollar will trade in. But if it gets up to a certain level, it starts to impact the earnings of global multinational companies. Bloomberg, Morgan Stanley Research, FactSet, they put out a chart, and relationship between dollar and EPS change is fairly weak statistically. All right. I don't know, they didn't list, whoever posted this on Twitter anyway, didn't list the time frame that this was. But basically, if you could see the chart, the year-over-year change in S&P 500 EPS on the y-axis, the left side, on the bottom, the x-axis, year-over-year change in the dollar index, and the R-squared on this is 0.0428. So it's basically saying not too much of a statistical relationship. I don't know about that. And I think the problem is this just looks at the dollar change and it doesn't look at whether it's out of that, what I call the zone of insignificance. So I have a problem with this chart. I'm sorry, I do. But
so there's some bull cases here, right? The bull cases for the dollar, right, is a strong U.S. economy and that the U.S. outperforms and interest rates remain high relative to the euro, the yen, the yuan. I think the bearish case, though, is just global diversification and weakening economics of the U.S., reducing interest rates, right? That would weaken the dollar. So I think that with the new administration coming in, people are expecting the dollar to be strong. They're expecting demand to be high. And the talk around the reserve currencies, right? I don't know if we've talked about that before, right? But there's some people who are concerned about the reserve currency of the dollar, but I think that should be, put out to pasture at this point, because I think it's become very clear that especially in international travels, is that the dollar is the reserve currency. Yes, so there's been a few deals here and there in some other currencies, but the dollar's so far ahead of everything else. It's not something I hear a lot about in questions and conversations with advisors and clients, but it's not something that I'm too worried about.
Yeah, I mean, the reserve currency, that for the audience, that's when people, like when you trade oil, that's done in dollars. and transactions are done in dollars. So the reserve currency means there's, I'll do that in another show, but it sort of having the reserve currency status does protect the dollar and protects our. Let me not go down that rabbit hole. I'll do that another time. All right, let's talk about earnings next week, Mike. We have Netflix, and I always like to take a look and see what the options market is telling us about the implied volatility. And if I look here, looks like, so going a week out, so the ones that expire next Friday, have an implied volatility of around 75% overall. So Netflix closed 858.10, and I go in, I take a look, and I say, well, let me look at right around the at the money, and they have an implied volatility of almost 74. So that is basically what the options market is telling us. We've got earnings next, I think it's next Tuesday. I think it's either Tuesday or Wednesday after the market. I could check that. And so this earnings expiration is the one that includes, the near one that includes that. And basically at a 75% or 74% volatility, divide that by 15.875. And the options market right now, the one standard deviation move expected just on one day is about 4.7%. So volatility is higher coming into earnings because the market is saying, we know earnings are coming up and we know that there's a chance that the market will really move. So the options market is already discounting that information. They're already putting that in. And if I look at the straddle, let's see, it's not really perfect because, 860 is $2, higher than it. But if I look at the straddle, if I bought this and I'd say, the cost of this straddle, meaning I don't care where it goes, I just need it to move a lot. That is going to be about $75, I think, right around $75 or so. So, that's the thing. It's saying if you buy the straddle, the stock has to move roughly, in this case, 8.75% just to break even. So if it moves more than that and you bought the straddle, all right, good for you. If you moves less than that, you could be right on the direction, but it didn't quite move enough. So this is one of the good examples of the options market. And if you're playing the home game, like I know buying a straddle might sound like it's an easy trade. It's actually one of the more, in my opinion, a dangerous trade because you are trading, it's a volatility trade, right. Pure volatility and direction there. And you could be right, but be wrong. And if you sell the thing and it moves more than you think, then you're on the wrong side of this. So I'll let you know when I know which of these, but I don't know, Mike, does Netflix even matter anymore? I think it does. I still think it does because it's the consumer. It's still a high profile name. And I think the other thing is it's a name that everybody knows. I think everybody has Netflix. So
yeah, I think so.
You think as a bellwether? It's sort of not really, it used to be a FANG and now it's the Mag 7, but it's not in the Mag 7.
Right. It's not in the Mag 7. Yeah. So you're right. Next week is a light week with the holiday on Monday. I think Netflix still matters, right? A lot of people look at that as the number one streaming service, right? So they still got to be number one, I think. But they have so much competition at this point. So, good idea around buying the straddle or selling the straddle. You're right. It's a vol play. If you're thinking there's going to be high volatility, right, you might want to buy that straddle. If you're thinking that it's going to be low volatility or it's just going to be a market mover there, right, selling the straddle might make sense. I would do
neither. I'm advising the audience not to do it. It's a dangerous trade. And yes. By the way, if you sell the straddle, you're naked on, unless you put it off. But there's other ways you could play it. But yeah, Mike, I agree. Netflix. Here's the thing with Netflix, and you sort of have to have it. I would say there's not great stuff on there all the time, but their interface is so much better. Like I've been watching the show The Agency, and I can't even trying to go to Paramount Plus and then pick up where you left off. Like it just stinks. Like Netflix is just, they do it right the way they do their interface.
Yes, I'd say it's one of the top ones. So and that's why I say I think it matters, right? I still think they're the number one streaming service. They have new comedians on all the time. They're constantly pumping out new shows. I still think they're the number one. I don't think they've been dethroned yet.
All right, let me go over to Bitcoin. And you and I were talking off air. And one of the things when I talk to people, I think you talk to them too, and I've seen this on Twitter. I've seen it. Mike, the videos are popping up. There's no way that Bitcoin can go down. And Jay's not on here this week, so I can get into Bitcoin a little bit. I can be on the bearish side or the skeptical side of it. But here's why I'm thinking this. It seems like everyone, at least the people on YouTube and stuff, are convinced that this thing is going to 87 million. I don't know what they think it's going to. But I've also started to see hey, if you're going to buy a car, finance it, don't pay cash, and put the cash into Bitcoin, and then you pay off your car next month because it's going to, of course, Bitcoin's going to go up. Anytime we have, and I'm being serious now, I know you are too, there's this herding mentality of everyone's on one side of an opinion. I don't know what's going to happen to it. I really don't. I've been wrong on Bitcoin. Everyone knows that. But I know you're seeing the same thing, Mike. It's almost, what'd you say to me? It seems like it's too easy to make money on this.
It's too easy. And that's certainly what scares me, right? Is when it gets too easy or it seems too easy. It's the old saying, right? Is when your cab driver is giving you stock tips, maybe it's time to get out of the market. Well, all the cab drivers are giving me stock tips when I'm traveling right now. So or giving you Bitcoin tips. Looking at some forecasts here. I mean, they're very, very bullish based on a few different things. One of them was the halving that happened last year. The market the Bitcoin or the crypto market has increased after the halvings. Forecast from Bitwise is possible 200,000. So it'd be a double by the end of 2025, right? So 100% return. That's a forecast, right? No guarantees here. But even some of the bearish cases are still 120, 150 for some of the kind of crypto firms out there. And what scares me is that it really is starting to be too easy, right? Everybody's just saying, I sold my stocks and I just bought some crypto or I bought some Bitcoin. Those types, when you start hearing everybody start to say that, everybody and their grandma tells you, I'm buying Bitcoin. It's usually when there's some type of crash around the corner. Not saying it's going to happen this time, but we're hearing it a lot. Institutional adoption was another one of the big things that we've heard. The Federal Reserve having a crypto kind of adopting crypto, that could be some type of Bitcoin reserve. It all kind of sounds ridiculous to me, Derek, when you think about where cryptos come from and kind of what we followed here. But that's what's in the news right now, and that's what's getting people excited.
I mean, all right. I mean, I could spend an hour about this, but why not just buy NVIDIA? Why doesn't the Federal Reserve just buy NVIDIA? To me, Bitcoin is not a currency. It's failed as a currency. Nobody uses it as a currency. But I digress. So no, I mean, I think, and I saw this. So I'm dating myself a little bit, but I remember when the emerging markets boom happened in the late 90s, and I remember in the mid 90s, 94 or so, everybody was buying Telefonos to Chile, Telefonos to Mexico, Telefonos to enter your Latin American country, and those stocks were going nuts until they didn't. And I remember going into, I've told this story, but I'll tell it again. I went to, was it the Wiz in New York area, and buying a TV. And back then you'd go in and you have a sales guy and you had to haggle over the price of a TV. And this guy has in his back pocket the Merrill Lynch Emerging Market Dragon Mutual Fund prospectus with the picture of the boats in Hong Kong Harbor on it. And he's telling me about it. And I'm trying to buy a TV and he's telling me about emerging markets. And I'm like, I should be short emerging markets tomorrow if this guy's telling me. So I don't know. I mean, the problem though is I mean, people like me have been wrong. So if you're doing something and it keeps working and people you know are doing something and it's working, then, you, there's been they've been right. It's kept working, but I think you're right. It seems too easy.
It does seem too easy at this point, and it's not stable, right? That's the where you're talking about. It's kind of failing as a currency. So you can transact it. What I will say, we're hearing a lot about is there's no, there's no international transaction fees, right? If you can, you could buy some Bitcoin in the US and then you could transact it in Europe and you don't have to deal with the transaction fees, right? So there's some small use cases scenarios for it like that. But it just seems like it's too easy right now. And I'm just looking at projections here. Galaxy Digital predicts 150 to 185. Let's see. Standard Charting's 200,000 prediction for 2025. Bitwise, like I said, was 200,000. HC Wainwright 225,000. Van Eck 180,000. So these aren't 5, 10, 15% predictions or recommendations or just suggesting that the stock could go to those levels. I mean, you're talking 80% to 125% returns over a 12-month period. It just kind of seems ridiculous. It's certainly possible. Like you said, you've been wrong. I've been wrong. I know a lot of people that did not like Bitcoin or crypto in general, but it seems to really, we're on the wrong side of this trade so far, Derek.
It's almost remember when 29 out of 30 leading economists said we were sure to have a recession in 2023? Like if you're a bear on this, you're almost like, oh, that's great. Everyone has such high price targets for it, but I don't know. I don't know where it's going.
Yeah. We'll you're on an island if you're a bear. And I do remember that, right? That was last year, right? 29 out of 30 analysts said the market was going to go down. We had a plus 25%.
23. It was 2023. I know all the years
23.
blend together. Yeah. It was coming into 23. That was when we were supposed to have a recession. So, all right. Another thing. So the unemployment rate, that's old news now. It was 4.1 last week. It was lower than expected. I had this on my list. I don't know if, all right, I'll just go into it. I do wonder, so somebody had sent me a note and asked me, does the situation in LA, and if, we have international listeners and I assume it's world news, but unbelievable fires in LA, like horrible. And somebody asked me, do things like that get priced into unemployment or baked into unemployment? And the answer is, I don't think anybody knows yet. And we've seen this with hurricanes where either there's a disruption in employment. I looked today and, Goldman Sachs said the forecast could knock maybe 25,000 positions off California's state labor department. I don't know. It's maybe. We'll see. It's and I don't pretend to be a fundamental analyst and certainly not focusing on insurance stocks, but I don't know yet what that's going to be on the insurance side or the utilities that are involved. So I'll leave that for other people. But to answer the question, yeah, it's possible. We won't really know. And, we'll see what happens there, but it's
Derek,
LA's a big city, big area was affected. And, so yeah, I don't know yet.
We were in a meeting today, right? And I heard a term I hadn't heard maybe in quite some time, which was a white swan event. Usually we talk about black swan events. But the white swan of the predictability of kind of the outcome of what's going to happen out there in California and the fires and all that stuff. So I thought that was interesting.
And white swans is sort of the idea that they are quote unquote likely to occur and can be predictable. Black swans are ones that come out of nowhere, and that's kind of the idea there. No, that's right. We were in that meeting and they mentioned white swans. Yeah.
Yeah, but we'll see what's predictable there, right? I think there's a lot of things that are going to have to be changed kind of with that city. And it's so unfortunate what happened. I was actually out in California last week and had to change my plans, and all my meetings got canceled because of that.
Nassim Taleb, by the way, is the guy who, now I will tell you, back in 2013, 2014, I had written about white swans. And white swans were really the idea of selling covered calls and markets sometimes moving much, much greater in velocity than people realize. But Nassim Taleb apparently had also talked about white swans. One of his things too is he thinks there's risk coming in the form of the debt spiral. And I don't know, this is a tough one for me. I know obviously our debt is crazy. Like, politicians spend money hand over fist like drunken sailors. And, but I thought debt was a problem in the 80s. And I thought it was a problem in the 90s and the 2000s. So it will be a problem when it's a problem, but we'll see what happens there. All right, Mike. Anything else we need to cover before we go to our recommendations?
No, I mean, I think we went pretty deep even into Bitcoin on this podcast. So I think we covered everything.
Jay will be sad he missed the Bitcoin discussion.
I believe
the
other
side from me.
It's one of you guys' favorite topics, I think.
How does Bitcoin? So I was looking at a chart the other day. Somebody pointed me to, and I guess, is it Ethereum? Ethereum has really gone nowhere while Bitcoin has gone up. And for
That's
a while,
correct.
Ethereum was the second one. And then I had all sorts of crypto people telling me about how it's going to change the world and all this stuff. And I didn't see the need for any of it, but that's just me. But Bitcoin, I give it credit. Like all the crypto stuff, that's the one that's sort of endured and come back. And it's even come back after it went down. So.
Yeah, well, the new one. So the big competitor to Ethereum is now called XRP. So I think those two are.
What does this one do?
Yeah, it's just some framework to build some of the other crypto stuff off.
What do we need the framework for?
We don't need it. We don't. I don't think we honestly need it. I'm just telling you what's kind of going on with one of the competitors to Ethereum. But yeah, Ethereum's currently priced at 3481. Yeah, nowhere near the price of Bitcoin.
I will also tell you that, I don't know about you, but I'm getting cold calls now, a lot of cold calls for private credit. Tons of people saying, have you thought about private credit? And that's the other thing. I feel like there's going to be, I'll just share a little bit of in the institutional world. So you have, outside salespeople that call, and I get called all the time from ETF companies, mutual fund companies, just different investments and all this stuff. And today alone, Mike, I think I had 3 calls on private credit.
Really? Wow.
Yeah. And that's the hot thing. It switches what the hot thing is. Like smart beta was hot back in, I don't know how many years ago. Like I used to get a lot of calls about smart beta, but I'm just telling you that. So,
well, look, and that brings us full circle to why we like the S&P 500 so much, right?
Yeah, and we hedge it. I mean, that's the thing. And rather than try and time the market, we're much better just buying the S&P, letting the index be the living, breathing thing that has members coming in, members coming out. And we hedge it because, hedging is relatively cheap right now. And the structure, it makes sense. And, if you're in the S&P, you're essentially a momentum investor and you are buying a lot of tech right now. So,
right. Yeah.
But we can hedge it. All right, Mike. I know you haven't been on in a while, but I borrow this from Barry Ritholtz has a show, Masters in Business, on Bloomberg. And I think it's in podcast form too. And he would, at the end, he would say, is there anything you've been reading, watching, or So, Mike, anything recommendation wise, like movies, TV, anything like that you've been looking
Yeah,
at
sure.
lately?
So I have started it. I haven't finished it yet, but it's new to Netflix. It's called Don't Die.
I saw that.
Yeah, the man who wants to live forever.
Brian Johnson, right? Is that the
Brian
guy's name?
Johnson. Correct. Yeah. So it's been very interesting. The first 30, 45 minutes or so that I've watched. So I haven't finished it yet. But, all of his anti-aging protocols and things like that. So I'm excited to finish that this weekend. But that would be my watching recommendation.
Now I'm trying to remember if I recommended that last week. I may have, because I've been watching The Agency and I've been complaining how all the episodes don't drop at once.
Oh, okay.
Yeah. Well, I mean, Peter Attia, Outlive, that book is an interesting book. But yeah, I don't know. For me, I'm still been watching The Agency and then NFL playoffs. That's
that'll be fun. Yeah. So playoffs this weekend will be great.
Yep. All right, Mike, that's it. We did it. We made it to the end, and don't pay attention to any of the recommendations Mike gave or I gave. Don't. I'm kidding. Like, we didn't give recommendations. So
yeah, just not here.
Buy and hedge. All right, Mike, thanks for coming on. We'll see everyone next week.
Thanks, Derek.